Most traders believe the morning session is where the real money is made. They wake early. They clear their schedule. They tell themselves that if they miss the open, they miss the opportunity. That belief feels responsible. It feels disciplined. It feels serious. And it is quietly destroying performance. Not because the open is random, not because it cannot be traded, but because most traders never ask a harder question. When exactly do they trade best? Years ago, a small group of experienced traders began noticing something uncomfortable. Their biggest wins were not evenly distributed across the day. Neither were their worst losses. The data was lopsided, almost embarrassingly so. They were optimizing entries, tweaking exits, refining position sizing, but the real variable had been hiding in plain sight. Time. Not the market's time, their own. This is where the story usually breaks from what trading culture expects. Because the market open is loud, it is active, it feels important. News hits, orders flood in, volatility spikes. Screens move fast enough to convince you that opportunity is everywhere. But speed does not equal edge. For many traders, speed simply amplifies weaknesses they have not yet learned to see. The first hour of the day is when narratives collide. Overnight headlines meet pre-market expectations. Institutions rebalance. Algorithms respond to flows that have nothing to do with your setup. And somewhere inside that chaos sits a retail trader trying to execute with precision. The problem is not that the open is unpredictable. The problem is that it is unforgiving. If your decision-making is even slightly delayed, the open exposes it. If your emotional state is not settled, the open magnifies it. If your rules are flexible, the open bends them until they break. This is why some of the most consistent traders quietly stopped trading mornings altogether. Not out of fear, out of respect for their own statistics. One trader documented every trade for years: entry time, exit time, outcome, emotional state, market condition. No opinions, just records. When he finally sorted the data by time of day, the results were uncomfortable. The majority of drawdowns came from the same window: early, fast, emotional. The best trades came later, slower, cleaner. At first, he assumed it was coincidence. Then he filtered the data further. Same setup, same risk, same instrument. The difference remained. This is where most people stop looking. They prefer to believe that improvement comes from more complexity, a better indicator, a sharper entry, a refined pattern. Time of day filtering feels too simple to matter. That assumption is expensive. Because trading performance is not limited by how much you know, it is limited by when you are most likely to misapply what you know. Morning sessions carry a psychological tax that rarely gets discussed. You are transitioning from the outside world into the market. Your nervous system is still adjusting. Your expectations are untested. Your patience has not yet been challenged. That combination creates a subtle urgency. You want to participate. You want to justify being present. You want to feel productive early. Those impulses rarely align with high-quality decision-making. Later in the day, something changes. The initial narratives have failed or been confirmed. The extremes have been tested. Liquidity has normalized. The market begins to reveal structure instead of noise. More importantly, you have settled. Your mind has absorbed enough information to stop guessing. Your emotions have experienced enough movement to stabilize. You are no longer reacting to the market. You are responding to it. This is not a motivational insight. It is a statistical one. When traders segmented their results by session, many found that eliminating a single time window improved performance more than months of strategy work. No new indicators, no new rules, just subtraction. That should unsettle you, because it suggests that effort is often misplaced. Most traders spend years trying to force consistency across all market conditions. Professionals do the opposite. They narrow their exposure to conditions where consistency already exists. Session selection is not about finding the best time to trade. It's about identifying the time you should not trade. The open punishes hesitation. It punishes emotional noise. It punishes overconfidence built on pre-market bias. Some traders thrive there. Most do not. The mistake is assuming that what looks professional must be productive. Cultural habits form quickly in markets. Early starts, long hours, constant presence. They look like commitment. But markets do not reward commitment. They reward alignment. Alignment between your temperament and the environment you operate in. One trader described it simply: "I wasn't bad at trading, I was trading at the wrong time." That sentence carries more truth than most technical books, because the market does not care about effort evenly distributed. It cares about precision selectively applied. Ignoring the morning session is not avoidance, it is calibration. It's an admission that your edge is conditional, that your clarity has a rhythm, that your best decisions do not arrive on command. Most traders never test this. They assume availability equals opportunity. The legends tracked it. They removed ego from the process. They stopped defending habits. They let the data speak. And the data was blunt. You do not need to trade all day to make money. You need to trade during the part of the day where you are least likely to make mistakes you later justify. This is not laziness, it is honesty. In the next part, we'll break down how traders identified their optimal session window, the specific metrics they tracked, and why most people misinterpret their own trade logs when they try to do this themselves.
Most traders who try to analyze their performance never get past the surface. They look at win rate, they look at average reward to risk, they look at expectancy, useful numbers, incomplete ones. Because those metrics flatten time. They treat every trade as if it happened in the same psychological environment, as if the trader was the same person at every hour of the day. That assumption quietly corrupts the conclusions. The traders who uncovered their session edge did not start with conclusions. They started with separation. They stopped asking, "Is this strategy profitable?" They started asking, "When am I most dangerous to myself?" That shift matters. They segmented trades by hour, not broad labels like morning or afternoon, but precise windows, 30-minute blocks, sometimes 15. Then they layered context on top: market condition, volatility regime, news presence, trend state. But the most important layer was internal. How fast decisions were made, how often rules were bent, how frequently size was adjusted mid-trade. Patterns emerged that had nothing to do with charts. Early sessions showed a recurring behavior. Trades were entered faster. Stops were moved sooner. Profits were taken early or not at all. Not because the setups were worse, because the trader was. This realization is uncomfortable because it removes the market as the primary culprit. It suggests that under certain conditions, you are systematically less capable. Not ignorant, not disciplined, just misaligned. Most people resist this insight. They prefer to believe that consistency means showing up the same way every session. Professionals understand that consistency comes from selective exposure. There is a quiet arrogance in believing you should be able to trade well at all times. Markets do not work that way. Humans do not work that way. One trader discovered that his morning trades had a positive expectancy on paper, but a negative emotional residue. He won often, but the wins were smaller than planned. Losses were rushed. By midday, his decision-making quality dropped. The cost of the morning session was not the trades themselves, it was what they did to the rest of the day. Another trader found the opposite. Mornings were acceptable, midday was destructive. Liquidity thinned, boredom crept in, overtrading followed. Same market, different nervous systems. This is why copying session rules from others rarely works. The framework is transferable, the conclusions are not. The framework is simple, but not easy. First, you stop trying to fix bad trades. You identify bad hours. Second, you stop measuring performance only in profit and loss. You measure rule integrity, decision speed, emotional volatility. Third, you apply brutal subtraction. If a time window consistently produces hesitation, impulsiveness, or narrative chasing, it is removed. No debate, no justification. Most traders fail at this step. They negotiate with their data. They tell themselves the sample size is too small, or that the market will change, or that they just need more experience. That resistance is not analytical, it is identity-based. Trading certain sessions becomes part of how they see themselves. Early riser, hard worker, always present. Letting go feels like regression. But performance does not care how disciplined your schedule looks. It cares how repeatable your decisions are. This is where the deeper realization lands. Session selection is not about avoiding volatility. It is about avoiding internal instability. Volatility can be traded. Internal noise cannot. Once traders accepted this, something unexpected happened. They stopped forcing trades during their best window as well, because they could finally see it. Their optimal session was narrow, sometimes just 90 minutes, sometimes less. Inside that window, patience increased, selectivity sharpened, losses felt contained instead of personal. Outside that window, nothing improved with effort. This clarity created confidence without bravado. They no longer felt the need to make the day work. The day worked if the window showed up. If it did not, they stepped aside. This is where most retail traders misunderstand discipline. They believe discipline means participation. Professionals treat discipline as restraint. The market does not reward time spent. It rewards timing aligned with competence. One trader summarized it after removing 2 sessions entirely. I didn't get better at trading. I got better at avoiding myself. That statement sounds simple. It is not. It requires accepting that your edge is fragile, that it exists only under certain conditions, that forcing exposure destroys it. This is why strategy refinement often produces diminishing returns. You are sharpening a tool you use in the wrong environment. The conflict most traders face at this stage is subtle. They now know when they trade best, but they feel guilty trading less. Fewer trades feel like missed opportunity. Fewer hours feel like reduced commitment. This tension leads many back into bad sessions, not because they forgot the data, because they haven't fully separated productivity from presence. The realization that resolves this conflict is the hardest one. Your job is not to trade the market. Your job is to protect the version of yourself that trades well. Everything else is secondary. In the next part, we'll move from realization to application. How traders implemented session filters without drifting back into old habits. How they handled days when their window did not appear. And how ignoring entire sessions changed their relationship with risk itself. Because once you stop fighting time, trading becomes less about endurance and more about precision.
The application of session selection is where most traders quietly fail. Not because the framework is complex, because it requires consistency in absence.
Once traders identified their optimal window, the rule was simple: trade only there. Nothing outside it counted as opportunity. The difficulty was psychological. Markets move all day. Screens invite attention. Alerts trigger curiosity. The urge to participate does not disappear just because the data says you should not. This is why implementation had to change behavior, not just schedules. The first adjustment was structural. Traders removed access outside their window. Platforms were closed. Alerts were disabled. Accounts were sized so that boredom trades could not slip through unnoticed. This was not about discipline, it was about removing temptation. They understood something most people overlook. Willpower is not a trading strategy. The second adjustment was redefining a good day. A good day was no longer measured by profit. It was measured by adherence. If the window appeared and no trade met criteria, the day was successful. If the window never appeared, the day was complete. This reframing was uncomfortable at first. It felt passive. It felt undeserved. But over time, it created a calmer relationship with risk. Losses that occurred inside the window were accepted without spirals. Losses no longer stacked across sessions. Recovery trades disappeared. The third adjustment was how they reviewed performance. Instead of asking, "Why did this trade lose?" they asked, "Did this trade belong in my window?" If the answer was no, the review ended. There was nothing to learn. This prevented overanalysis. It stopped emotional trades from being dressed up as lessons. The final adjustment was patience with absence. Some days, markets never aligned with their window. No trend, no volatility, no clarity. Early in their careers, these days would have been filled with forced trades. Now they were left empty. This emptiness felt like failure until it was reframed. Nothing lost is a position. Over months, something subtle happened. Account curves smoothed, drawdowns shortened, confidence stopped swinging with daily results. Not because they won more often, because they lost less often when they were least capable. Ignoring entire sessions changed how they viewed the market. It was no longer an opponent demanding constant attention. It became a landscape they visited selectively. This selectivity created distance, and distance created objectivity. The morning session, once sacred, became optional, not avoided, just unnecessary. Some traders eventually returned to it years later with different nervous systems and clearer rules. Others never did. The point was not which session they traded. The point was that the decision was intentional. The lasting lesson is quiet. You do not need to be present for every move. You need to be present for the moves you are built to handle. Markets reward alignment more than effort. They punish exposure without self-awareness. Most traders spend their careers trying to expand their edge across time. The ones who last do the opposite. They contract it. They accept that their best decisions live in narrow windows. They stop apologizing for that. And in doing so, they trade less, but they trade with fewer regrets. That is not optimization. That is maturity.